For more on the Fed's next move on rates, former Fed Vice Chair Roger Ferguson, he's former president and CEO of TIAA and is now a distinguished fellow for international economics with the Council on Foreign Relations, also a CNBC contributor. Roger, thanks for joining us. Would you have done 50 at the last meeting? Some people, I guess, were arguing for that. Or would you likely do it at the next one? Or would you go slow and steady and wait for more data?
I think I would have been more in the 25 basis point camp the last time. It is quite clear, as Chair Powell and even Presidents Mester and Bullard noted, that the disinflation process is underway. It may be moving more slowly than we like, but they put a lot of tightening into the system. So I think I would be 25 basis points the last time and probably 25 basis points at the upcoming meeting, depending on what the incoming data tell us.
We're waiting for Godot. You're right. We are seeing a little disinflation, but it's not. We're all in a rush in this world, Roger. We want things to happen right away. But are you frustrated at all that the effects seem to be having a longer lag than some would have expected? And what do you attribute that to? The vibrancy, and I'm saying these things like they're bad, but the vibrancy and the resiliency of the consumer and the economy itself, what do you attribute that to?
Well, let's start with the point that you're making, which is, we shouldn't lament the fact that we have a strong underlying economy. This situation is highly unprecedented in that we had a large amount of stimulus put into the economy for very good reasons to help us get out of the pandemic. We had follow-on stimulus that reflected, the political desires to invest in infrastructure and deal with, a changing society. We then had a very unusual set of circumstances with the closing and reopening of the economy that made for dramatic swings from goods that had been under disinflation back to inflation, and also services. And we started at a place where interest rates were historically low. So there's a lot of forward momentum that the Fed is dealing with, and that's both good and bad. It means that the process of disinflation maybe is taking longer than people had expected. It also means perhaps that the Fed can engineer that rare thing, which is a soft landing. And so I think they'll keep going. I think they need to keep going, probably to rates that are higher, a terminal rate that may be somewhat higher than the market had been expecting. And I think they'll hold it there for maybe longer than the market wants to see if they can engineer what they're hoping for, which is inflation coming back down over a period of time to 2% without throwing the economy into a deep recession.
Yeah, quite a big ask, Roger. Is the term that things happen gradually till they happen all at once? I don't know if I want to hope for that, but I'm thinking that, we're seeing layoffs in a lot of different sectors, and there will be a lag effect to all the tightening. Do you think suddenly one of these data points that we see in the coming weeks could all of a sudden be, oh my, wow? But that's why I think both of us are expressing, that there should be some caution. Be somewhat circumspect about 50 basis. Let's go a full point to really, so that we can see the effect. Could it happen all at once?
So I think you're making a number. I don't think it's going to happen all at once, but I think you are making a number of good points. One is we've always said that monetary policy works with long and variable lags. Our economy depends to some degree on what happens in Europe, if that had been a deep recession, or this reopening in China. Is that going to fuel more inflation? We just don't know. And so I think you're right to suggest moving along to wait to see the impact of the work they've already done. Having said that, I don't think that these announcements of layoffs are a precursor to a dramatic swing in the job market. The layoffs that we're talking about are in the thousands. The job market is much bigger than that. We see, very large openings, and so I don't think people should be fooled into thinking, oh, these headlines are suggesting a dramatic swing in the labor market. There's still a number of sectors, particularly in the service sector, small and medium-sized companies, that are having a hard time filling job openings. And you hear less about that. So, yes, I agree with you on a lot of tightening. Yes, I agree on long and variable lags. Yes, I think they should be moving at 25 basis point increments at this stage. But no, I don't think we're going to suddenly wake up and find a dramatic swing. I just don't think the economy works that way.